From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 7th, 2024. Checking the calendar, the Brewers are spending the weekend in Detroit. See, your weekend plans could be worse. There's some fun stuff happening in town. Pride Fest continues through Saturday night. Also Saturday night, there's Donny Osmond at the Riverside. Just a heads up, he's 66. We have a couple of new fests this year, both on Saturday. The Water Lantern Fest at Veterans Park. I think the description is in the name, Water Lantern Fest. And if that's not enough to fill up your Saturday, there's Cicada Palooza in Lake Geneva. All right, here we go. A woman in Nebraska was pronounced dead at her nursing home, only to be found alive at the funeral home. Her death was anticipated by the staff, so no one followed up when the nursing home pronounced her dead. Apparently, all you need is to have someone on the staff say, "You're dead," and that's it. I'm not sure, but I think there's a flaw in that system. A Scottish toddler was suffering sinus pain and fatigue for 3 months. After a series of unsuccessful doctor visits, they called an ENT specialist, ear, nose, and throat specialist. He solved the problem right away. He fished a raisin out of the 3-year-old's nose. Every parent knows that's possible. This is kind of funny. Bill Gates and Warren Buffett are two of the richest men on the planet, and they both have a McDonald's Gold Card. That means free food for life. But there's one distinction. Bill's card is good worldwide. Warren can only get free Mickey D's in Omaha. Life is so unfair. And here in Wisconsin, we have more than our share of highway mishaps. But thankfully, this didn't happen here. On an Oakland, California interstate, there was a wet meat spill. A truck carrying chicken and beef parts, and you know what kind of parts we're talking about, spilled its entire load right onto the highway. The freeway was closed down for 4 hours, while some poor road crew had to clean up the mess. And I'll leave you with that visual. On the podcast today, we have Art Rothschild, Mike Hoelzl, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A pretty good week overall for stocks. The NASDAQ up 2.4%, closing at 17,133. The S&P 500 up 70 points on the week. That's 1.3%, closing at 53.47. The Dow Jones Industrial Average up 113 points, despite giving back 87 on Friday. That's up 0.3% for the week, closing at 38,799 at the bell on Friday. For the year, NASDAQ now up 14.5, the S&P up 12.7, and the Dow Jones Industrial Average up 3.8, all including dividends. You know, Art, maybe the place to start this week is with the Fed. We had foreign central banks this week finally following through on what it seems we've been waiting on the Fed for the better part of maybe 6 months at least. Both our neighbors to the north and the European Central Bank making the decision to cut their overnight lending rates, and yet the Fed still holding fairly firm for now. But I think it speaks to the bigger picture about what the Fed really cares about. I know you look at this quite a bit. I know you get asked often, and it's probably a focus of a lot of your client meetings on what's the Fed going to do. So, Art, what's the Fed going to do?
You're not going to hear it from me, man. But yeah, I really liked this week. I mean, it was good. It felt good to be making money for the most part. Interest rates went down and up. That's pretty normal. As I said on the show a few weeks ago, I'm tired of waiting, with reference to the Fed, but it's not really me that's tired of waiting. It's the market speculating on a regular basis as to what they're going to do and when they're going to do it. I thought it was interesting that we're dealing with countries with different problems that they have to solve. I mean, it's similar and different. Okay, inflation is the concern of every one of these countries. But our economies have been growing so rapidly that the Fed really has to be very, very careful before lowering rates here. Europe started the recovery kind of after ours, I believe, and it definitely hasn't been as strong. And so I really think it's important for them to lower rates to stimulate their economy. And I'm not as worried about, and I don't think they're as worried about inflation over there. And Canada, our neighbor to the north, I think they're kind of tied to our economy. which explains, of course, the fact that they just cut from 5 to 4 3/4, which is very close to where we are anyway, and Europe's rates are lower to begin with. So I think the Fed, I just love, the Fed doesn't get enough credit for how well they've done on major problems. Think 2008, Great Recession, think getting us out of the problem we were in, with COVID, 4 years ago economically. And they're just managing what is no longer a crisis very well. They have a dual mandate. They have to be careful that we don't weaken so much so that we're in a ditch before we know it. And so they have to be ready to lower rates. But for my money, I think they're doing exactly the right thing. Data-driven, data-dependent, and the numbers that came out today, which you guys are going to talk about further, I'm sure, with respect to more people getting jobs than was anticipated by, again, a country mile for, I think, at least the second time this year. I'm absolutely thrilled with where we are, especially when you consider it's summer and we have summer doldrums and sell in May and go away, as we've talked about before. Don't think about it.
I agree completely, Art. I think the expectation for rate cuts continues to hang out there, and I think the reality is the longer we can kick that can down the road, the better off we probably are. If the reason isn't that inflation is still far too high, if inflation continues to moderate, and we just don't need to cut, or at least meaningfully cut, because the growth picture, the economy itself is strong enough, well, I'd say that's probably the best of both worlds. You've got rates now for safe investors that can provide far more yield than what we've seen, save for maybe the last 2 years, far more than what we saw in a very long time. And you've got an economy that is firing on just about all cylinders, maybe not all 12, but maybe 11 to 12 you're doing okay with. And so I think if the story is that, yeah, some of the rest of the world is starting to see some signs of weakness, they might need to pull back a little, and the European Central Bank was clear, hey, we're doing this because we can. We're not necessarily committing to many more cuts, though. But if the rest of the world is in that environment already and we can keep pushing that out, I think it speaks to just how strong the U.S. economy really is. And Joel, I think one of the things that supports that is some of the employment data we saw today. Art alluded to it, but I wonder if you could speak to it a little more broadly.
Yeah, Kyle, it shows strength in the economy, but it also shows weakness. So it's feeding that speculation on what the Fed's going to do when their open market committee meets next week to talk about those interest rates. As Art said, we had job gains higher than expected. It was the 41st month in a row that we've added jobs to the economy, and month to month, a lot of times it's exceeding analysts' expectations. On the other hand, the unemployment rate went up to 4%, and that's the first time that it's been that in more than 2 years. 27 months it was below 4%, which was the longest streak since the late 1960s. So kind of mixed news there. There's a U6 sort of an underemployment rate that is at the highest that it's been in 3 years. And at the same time, we've got numbers on the prime age labor force participation rate is the highest it's been since 2002. The prime age labor force participation of women is the highest it's been ever. So there are some positive signs among things that are, we had other kind of negative signs earlier in the week with job postings being down the lowest that they've been in 3 years, and people are quitting their jobs less frequently and below the levels that they were even before the pandemic. And usually these quitting numbers are usually a sign of people's confidence in being able to get work again. So kind of a mixed bag of things, but overall it's a strong economy that we're seeing negative news from.
Yeah, and I think the labor market can be so unique month to month, but it is those longer term trends we look at, and it's why, an unemployment rate in and of itself doesn't tell the whole story. A single job openings number or employment number doesn't tell the whole story. But when you put them together and get a picture of an economy that clearly is strong enough. And I think strong enough is really the key. We're not looking for the economy to grow 5 or 6% a year. We're just looking for stability. We're looking for the opportunities for businesses that are going to be able to grow productivity, going to be able to grow their own profitability, to have an environment to operate in which they don't have to worry about, well, the house is going to fall apart around us. And so I think that's key.
Employers are still hiring. They're still paying good wages that are going up faster than inflation overall. And both of those things are good for the economy.
And amidst all this, Mike, we've got plenty of data for investors to digest, plenty of headlines that seem to jump out on a great stock having a great day, a pretty irrelevant stock having a great day or a bad day. I think you add in, just market broadly, seeing record levels and then pulling off those record levels. And I think there's a pretty interesting story developing about how misleading some of those data points can be for investors when you think about just how strong of a year it's really been compared to some of those maybe snippets of information that might motivate them to make some decisions that aren't necessarily backed by the underlying data.
It is quite a story indeed, Kyle, because it's as you said, the market is doing very well this year. What is it? Year to date, NASDAQ up 14.5, S&P up over 12.5, and yet I get clients that I talk to that say, well, how much am I down? And that's how they kick off the meeting. And I just kind of stare at them slack-jawed like, no, you're very positive for the year. That can't be right. I mean, I am in the business of just lying for my own benefit, obviously. Just kidding, everybody. But no, you get these days, or you get a bad day in the market, right? Okay, that happens. It doesn't mean it's a bad year or a bad quarter. I mean, athletes have bad games. That doesn't mean they have bad seasons. People have bad days. That doesn't mean they're horrible people. So, but people get so fixated on, as you said, Kyle, a headline that they see. And there's so many headlines out there. You can find one that wants to fit your narrative, or they see the big red number on Jim Cramer banging those stupid pots and pans or whatever noises he has on his show. And they say, oh my God, the market was down 0.3 today. My portfolio must be down 4 or 5 or 6. And it's just not the case. When you look at all of the data that you guys have all talked about, this year is on a great start for the market, and it's just looking positive the rest of the way. Now, again, as I tell all my clients, it's not going to be a linear fashion. If the market just went up, up, and up linear, we would not be sitting here right now, because it'd be completely pointless for us, because we'd all just invest in the same things and everyone would just ride the same wave. But you look at like where the market is in relation to jobs, in relation to wages, in relation just everything involved, and it's a really nice cocktail for going forward in this year. And yes, I said cocktail on purpose because it is Friday afternoon for everyone.
I think certainly our listeners are fairly well informed about how their portfolios are actually doing. I think when you look at the investment world more broadly, you get a lot of that overreaction simply because there's this constant fear of missing out, right? There's this constant fear that the meme stock that everybody's piling into today is the thing you have to have in your portfolio. And Art, I think a good reminder for investors, if they have even any kind of diversification in their portfolio, they've probably got some of those record setters as part of what they're holding.
Yeah, my favorite one at the present time is one of the Magnificent Seven that we've talked about that I hadn't even heard of. It was 3 years ago, NVIDIA. I had a client call this week, wanted some NVIDIA, and he's got some NVIDIA. But all of our clients have some NVIDIA. It's not the individual stock, but any respectable growth manager has that as one of the stocks in their portfolios where they're not doing as well as others. So it's sort of like Greyhound used to advertise, I forget how it started, but
take the bus, leave the driving to us.
Yeah. And that's what our job is, to develop portfolios. You had a great article talking about the importance of really balance, but your optimism about what's going on in equity. So we mix the caution that comes from having safe things, bonds and cash, with stocks which represent optimism, in the economy going forward. And then I love Joel's article in our last newsletter talking about collections.
That's because I quoted you in it.
Well, that's why I like the article. But now he gave me the book that he mentions in the article, so now in my office I have something older than I am, which I will point out to my clients when they come in. Whatever that was.
I think it is just such a critical reminder that there's a difference between having exposure to things and being overexposed to things. And we can look at reports and pull out, here's what your portfolio looks like, not just on here's the headline name, but here's the underlying positions, right? Not just what's the mutual fund or exchange traded fund, but here's the underlying positions. And all the time I get that question of, well, why don't I have more in this? And then when you really look through, right, when you really digest what's in the portfolio, you start to get a picture of, no, actually I do have quite a bit of exposure to that. Maybe it's not as much as what I might want after a great run in a stock like NVIDIA, but it is a big part of what I do. And when I think I have looked at portfolios, it's amazing how concentrated those really maybe top 20 or 25 names are. They tend to represent 25 to 30% of most portfolios. And so when you think through what are my exposures, well, a good portion of your portfolio is probably exposed to those very names that you're thinking about when you think what's doing well right now. And that leaves the other 75 or 70%. And the question there is, well, why don't I have more? And the answer is, well, because while we're reasonably confident that these are good opportunities going forward, there's going to be points in time in which you need something different. We're not so naive as to think we're always going to be right about what those times are. And so I think if you're just a little bit more cautious, yeah, you can take that risk. You can maybe have a little extra in some of those names you like, but you do want to have the diversification that's necessary.
And Kyle, that's important talking about the big names, but you were also alluding to some of the lesser names that have come up. And then we had a discussion last week about meme stocks, and there were more developments on this week. And I liked in the notes that you had prior to us getting together, one of the things you said was trading is not investing, which I thought was worthwhile.
Well, and I think we often miss that, right? Because the investment landscape is not a landscape that cares about what's happening right now. It does because it matters for the long term, but what you're really doing is investing in the future growth of a market, the future growth of a company, the future growth of an economy, depending on how you're, allocating your resources. And when you're trading, what you're really doing is saying, what do I think is going to happen to this position later today? How can I take advantage of some YouTuber, some internet poster that wants me to feed his growth, his profitability? How can I buy into that? And so it is important to separate kind of the fundamental drivers of investing from some of that more technical, just simply trading, right? Should I buy into that meme stock that everybody else is piling into? Well, by the time you figure it out, you might be the last one in, and you're going to be the one that's left holding the bag then as everybody else now starts to get out on the other side. Joel, we had a little more economic data this week worth pointing out, in particular ISM Services Index. I like to look at ISM both on the manufacturing side and services side as kind of a benchmark for how's the economy doing? What are we really seeing right now more broadly? Services obviously a much bigger part of our economy than it used to be, and so it's carried a greater weight than maybe we saw 25 or 30 years ago, and signs there at least a little bit of some growth again.
Yeah, so that index from the Institute for Supply Management showed that that sector of our economy, which is the greater part of the economy, is growing again in May after contracting actually in April, and it's one of the highest ratings that it's had for a while. It's the growth is going a lot better. It's really the 17th month in a row that by using this measure that the ISM figures that the economy has been growing, the economy overall, the GDP, and they figure that based on the ISM reading that the economy right now is growing at an annual rate of 1.6%, which doesn't sound like a lot, but it's growth nonetheless, and it's actually higher than what the official GDP number was, the last one that we had for the first quarter, and that was 1.3%.
And some mixed data on the manufacturing side. The ISM Manufacturing Index maybe showing a little bit of contraction, but at the same time, you've got a bit of a bump in factory orders. And again, we're going back a month further in factory orders versus manufacturing, but some signs that the economy, again, showing some of that mixed bag, but stability that we're hoping for.
Sure, and for those who are wanting the Fed to get to the rate cutting sooner than later, these are good signs. It's the bad news is good news, that the economy, as far as manufacturing was concerned, is in contraction for the 18th time in 19 months. Not by great guns, but it's not robust, and it's those little pauses in the economy that are going to help convince the Fed that as their partners in Canada and the ECB did, is that maybe we need to lower the rates to get the economy going again.
Yeah, and of course lower them, but not so much that we get pushed back into the environment we were in,
right,
10 years ago. And so I think as we maybe put a cap on first week of June, a good start to the month of June, a good start to, depending on who you talk to, summer. It's been warm enough around here. I think we can put that label out there now. But I'd say pretty pleased with where we are so far, pretty pleased with the week we just had. And as always, enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.